Welcome back to the Investing Markets and Money podcast with the Armchair Trader. And this week we have an update on precious metals markets. And joining us on the podcast is Nitesh Shah, who's head of commodities at WisdomTree, the ETF fund manager. And we're going to be having a number of updates on precious metals markets, not just the usual ones, but some of the more esoteric ones as well. So stay tuned for that. Welcome to the podcast this morning, Nitesh.
Good morning. Thanks for having me back on.
Obviously the precious metal most people are familiar with and are likely to have in their portfolios right now is gold. So I thought we would start with the gold price. It had been doing very well, but in recent days came off a little bit. A lot of speculation that has something to do with the outcome of the US election. What's your view on the gold price at the moment and what's driving it?
Yeah, so you're right. Gold had a fantastic number of months, hitting all-time highs almost every month for the last 6 months, and it was clear that gold seemed to be defying the odds. It was rising even at times when bond yields were increasing. It was rising even at times when gold prices, when the dollar was rising. But there were a couple of months, like in September and October, when everything was aligned for gold. We saw a marked improvement in investor sentiment. We started to see dollar depreciation. We just started seeing bond yields come down. All of these things together were all positive drivers for gold during August and September. And things started to wobble a bit in October in terms of the drivers. Like we started seeing bond yields increase and dollar come off, but gold still, nevertheless, kept going. And I think what was the big driver in October was elevated geopolitical risks. Middle East tensions were still rife. There's no real resolution to the Russia-Ukraine war. And there was increasing nervousness about the US presidential elections. The elections, the polls were showing things being pretty much split. And I guess people worried about what would happen if there was a prolonged process of deciding who's the new president. I think we've had all the answers with the election. It was a decisive win for Trump. And with that one layer of uncertainty has gone away. So that's one of the pressures that were pushing gold prices up has gone away, that uncertainty on the US presidential election. But secondly, we've seen a market increase in bond yields in the US. US 10-year treasuries are now trading at around 4.4% yield at the moment. And put in context, 10-year bond yields had gone down to around 3.6% in mid-September. That's a massive jump upwards. So that's one major headwind for gold. And the dollar, if you look at the dollar basket, that's appreciated more than 5% in the span of a month. Another big headwind towards gold. And that's why we've seen gold prices come off quite a lot since the US presidential election. And I guess we shouldn't be that much surprised. Last time Trump won the presidential election in 2016, gold prices fell off at that time as well. And one of the narratives around that 2016 election was there'd been a lot of gold buying by Republican-leaning voters who were fearful of their worst nightmare being realized, as in Clinton becoming president. When that didn't happen, they sold off some of their gold, and we possibly are seeing some of that similar pattern reemerge this time around as well.
So with obviously Trump looking like he'll be sworn in as the next president in January, does it look like, as far as the US politics is concerned, that story's off the table now? I mean, you mentioned geopolitical risk. You haven't had any big news coming out of the Middle East. Ukraine, obviously, that conflict continues. Does that mean that now the gold market's almost waiting for the next big piece of news, and for the time being, people will be quietly starting to sell their gold assets.
Yeah, I think, we've seen a fall in gold prices, but that usually opens up a nice entry point, because a lot of the risks are still there on the table, right? The Middle East risks, as you mentioned, yeah, things may have quietened a fraction from where we were last month when Iran was firing missiles directly at Israel. We know its response has been somewhat measured, but once again, there's always chances for that to be provoked again. Um, and I know that President-elect Trump said he'll solve the Ukraine war issue in the span of a day or a week or something towards those timeframes. I don't think it's that simple. I don't think it's that easy to do. And certainly, the Ukraine population, want to. Uh, want to witness the justice, right? So I don't think these wars are going to go away that quickly, and therefore the geopolitical premium that's in gold should remain. Um, Moreover, yes, in the context of the US, yes, lots of answers have come, right? The Republicans have basically got their red sweep, right? They got a Republican um, uh, president in the White House come January. They have control of the Senate and the House, right? So yes, there's possibly more ease for uh, policy making in the US, but what is likely to come based on Trump's campaign platform is increased indebtedness in the US, right? Trump seeks to slash taxes, but not necessarily slash spending. That just means higher borrowing. With that, we're likely to see another force for upward pressure on gold, and quite frankly, that's what's driven the increase in bond yields, right? The lower perceived quality of U.S. Treasuries with the increased bond yields is because people are worried about increased indebtedness. Normally, increased indebtedness is a force for gold price increases. That's probably why we've seen gold prices remain quite resilient in the face of such a large increase in bond yields. But going forward, it may just be that gold prices rise substantially with that increase in indebtedness that we foresee. Um, One other aspect that may have driven a bit of cooling in gold prices has also been the fact that prices have gone up so much, right? Price sensitive markets, particularly retail markets in emerging markets, have pulled back a little bit with buying. We saw that notably in China. India remained resilient, but for a reason, because import duties in India were slashed back in July, and last month we had the Diwali season, which is a big sort of buying season for an auspicious time for buying gold, and therefore we saw a really that kind of seasonal jump in gold combined with that slash in taxes, but maybe a lot of that gold buying has already taken place, and that's why we've seen a bit of cooling of demand since of prices since then. But one other area we may have seen a cooling is with central banks. The Chinese central bank, the People's Bank of China, hasn't reported any gold buying since May. So that has been one of the tailwinds for gold that's possibly come off. But I don't think it's come off in a permanent way. I think China will continue to buy gold, and maybe the little price dips that we've seen in the last few weeks will be the inspiration for that. Um, if you look at other central banks around the world, they have been buying and buying in quite large volumes. Central Bank of Poland, Kazakhstan, Turkey, India, they've been buying in pretty large volumes. So the slightly lower central bank volumes we're seeing right now is mainly because China has come off. And I think China will come back, especially as it seeks to continue its de-dollarization policy, especially if it could be at the brunt of a lot of the forthcoming, trade wars that we expect with a Trump presidency, because that has been part of the campaign platform to tighten up trade, especially with China.
Do you think that's the main driver for the central bank buying that we've been seeing? Because, or do you think it's the what we talk about sometimes, the weaponization of the dollar, where the dollar is the world's reserve currency and it's used by the US to beat up other current countries from time to time? Is this a quest for an alternative to the dollar, basically, on the part of central banks, or is that just overstating the case?
Yeah, I mean, if you ask central banks directly, they'll probably say no, we don't have a de-dollarization policy. Certainly, if you look at the World Gold Council's survey of central banks, if you look at the rankings of reasons for why central banks buy gold, they put de-dollarization, and weaponization of currencies as kind of the lowest ranking reason for buying gold. But if you look at the behavior, is clearly something that changed in 2022. And that was the time at which the dollar, not just the dollar, but the yen, the euro, and all G7 currencies were effectively weaponized because they froze Russia's central bank assets in those currencies. And that's when you saw that massive surge in central bank buying. In 2022, we saw average central bank buying um, double the levels of the previous 10 average of the previous 10 years, right? That's a market change, and that market change in behavior had to have some sort of catalyst, and we believe that weaponization was that catalyst. So I think central banks want to de-dollarize because they realize you fall on the wrong side of any G7 country from a geopolitical standpoint. It could hurt, and the evidence is there with Russia. um, and I think a lot of central banks, recognize that there is very few alternatives to the G7 currencies as well as reserve currencies. China's got massive capital controls, so it's hard to use the renminbi. Most of the currencies are relatively small or have inconsistent, um, you know, uh, monetary policy that makes it very difficult to use them as reserve currencies. But gold is very unique. It's not controlled by any of the central bank, so no central bank can put a sort of a sanction and embargo on usage of the asset. And its supply is very much controlled. You can only get as much gold that comes out of mines each year as new supply. So the currency or the pseudo currency can't be debased like traditional fiat currencies. So central banks are clearly moving more towards gold, and China's pause, I think, is just going to be temporary. If you look at China's gold as a proportion of other FX reserves, it's only running around 5.5% at the moment, which is tiny when you compare it to, say, um, you know, Germany, Italy, France. They've got that same sort of percent in 60, 70%, US 70 odd percent, Russia by 25 to 30%. So China's gold to FX ratio is very, very small, partly because its FX reserves are huge, right? It's got more FX reserves than any other country, more than double the next largest country, which is Japan. But to be able to get sort of some rebalancing of that, it needs a lot more gold, and it could be buying uh, gold in the volumes it's been buying in the last few years for decades to come. To get to, just to say, a gold to FX ratio of 20%, it needs to accumulate the equivalent gold holdings of combined holdings of Germany, Italy, and the UK. It's that much it needs. I don't think it can afford to be as price sensitive as it has suddenly become over the last few months. If it really does have that diversification policy, and I think that is something that will drive gold prices higher. Um, but even if it's not central banks that are driving gold prices higher, if we do get a pullback in bond yields and the dollar, and even with some moderation in inflation, we expect gold prices to hit around $3,030 by September of next year. So that's some considerable upside from today's levels, and clearly we've seen a nice new entry point being broken out in the last few weeks. Because believe me, in the last few months, people were just keep worried about, we've missed the entry point. We've missed the entry point. Well, now here's a nice one. Here's a nice one that's opened up.
Talking of entry points, the other big precious metals market is silver. What are you seeing in the silver market right now?
Yeah, so silver made started making some huge catch ups towards gold in the August to October timeframe. Um, and it was a little bit slow off the mark, but once it got going, it was really zooming. So silver reached an 11-year high back in October, and it's clear that people recognize its leveraged role against gold, and that kind of relationship really resumed. And silver has actually been, year to date, the best performing metal. And when I say best performing metal, I mean of all metals, not just precious metals, but even of the industrial, if you include industrial in the group. Um, and back in October, we were talking about 43% year to date. Towards the end of October, it's come off a little bit with gold, because there is that leverage play in gold. So when gold prices rise, it rises a little bit more, and when it falls a little bit more. That kind of relationship is about 1% gain in gold prices usually is associated with about 1.4% gain in silver, and vice versa. So. Um, with that sell off in gold, silver has come off as well. Um, but we believe it's going to be a fairly temporary thing, as it is with gold. And so when gold prices resume their upward trajectory, silver prices are likely to rise. And we believe that silver's got some extra sort of tailwinds behind it. One is that it is in a supply deficit. And what we mean by that is there's less mine supply of silver um, uh, today than there is consumption of silver. And that means we are eating up above ground inventory of silver. Now, fortunately, there's plenty of above ground inventory of silver, so long as those holding that inventory are willing to give it up. But obviously, those holding silver will only be willing to give it up at the right price, right? So that keeps upward price pressure for silver. Um, Now, it's hard to increase silver supply that easily because silver comes as a byproduct of mining for other metals. And there's not a massive increase in capital expenditure in the mining world at the moment. Now, um, our analysis shows that mining capital expenditure is highly correlated with industrial metal prices, with around an 18-month lag. So if you look 18 months ago, industrial metal prices were falling. And we expect that capex in mining to continue to be decelerating for the next year or so. So you're not likely to see general mining activity pick up, even though we've seen a nice pickup in industrial metal prices and silver prices recently. Um, Also, although we've been in a bit of an industrial recession, and silver is very much a industrially inclined precious metal with about 50% of its use in industrial applications. Silver's defied the odds, right? Industrial applications of silver have actually been rising. Um, and one of the reasons behind that is particular uses. Silver is used heavily in photovoltaics, solar panels, And solar panels sales have just been booming. The installations have been rising substantially. China's production of solar panels is rising substantially, and each solar panel today uses a lot more silver than they used last year or the year before, because the most efficient solar panels today use higher silver loadings, and that's a break from what we saw, a few years ago when there was a lot of thrifting going on in silver usage in solar panels. The newer technologies use that higher silver loadings. But it's not just photovoltaics. The electrification of a lot of things um, uses a lot more silver contact points. Think about the infotainment systems in cars, the safety devices in cars, the huge electrification of um, the applications in houses. Artificial intelligence gives a lot more role for um, uh, electronic equipment that's using AI software, and that's using a lot more AA contact points. Sorry, silver contact points, and so silver usage is defying the odds against the industrial recession. But with the stimulus that we're seeing, with interest rate cuts, etc., we're likely to see the industrial cycle also turn as well, which adds a new tailwind for silver demand going forward. So we expect those deficits to persist and silver prices to rise. So silver prices, we believe, could go to close to $40 an ounce by the third quarter of 2025. So that's substantially higher increase than what we're seeing for gold, and that really emphasizes how silver leverages off gold, but also gets an extra tailwind from these industrial applications.
And I wanted to ask you also about the platinum market. Obviously, another market that is classified as a precious metal, also has industrial applications like silver. We've looked at it quite recently ourselves, and we've done some technical analysis on the price, and we've seen some sort of medium term upward momentum on that. What's your view on the platinum market right now, and the potential drivers as we go forward to 2025?
Yeah, so platinum is another market that's actually in a supply deficit, which um, sounds like it should be good for the prices. Unfortunately, the platinum prices haven't been anywhere near as strong as gold and silver prices, because people are looking further into the future and recognize there is this mass electrification of vehicles, and when you fully electrify mobility, there is very little role for platinum and palladium and other platinum group metals. Um, but what we recognize is that that pace of electrification in certain markets is slowing. Not in all markets, but certain markets are slowing. The sort of the mandated retirement of internal combustion engine vehicles in many European countries is being now pushed out, and in the US, with the new administration in particular, I think the desire to electrify at a national level will probably be watered down a little, especially if Trump pulls out of the Paris Agreement once again and rips out of some of the aspirations for decarbonizing. That could drive internal combustion engine vehicles to have that second lease of life, and the platinum group metals could see increasing demand in those markets. I should caution that it's not this trend is not seen throughout the world. And if you look at China, it's electrifying like crazy, right? It is moving towards electric vehicles at a much faster pace than anyone had previously imagined. More than 50% of vehicle sales right now are electric vehicles, and China knows that it can reduce its import bill on oil by electrifying even faster. So that's a separate market. But in Europe and in US, we may see a little bit of a slowdown of that trend, which could give platinum and palladium that much more source of demand. Now, concurrently, the supply of both of those metals is quite concentrated. Um, you know, about 80% of platinum comes from South Africa. Um, and when it comes to palladium, about 40% comes from South Africa, 40% comes from Russia. Um, Russia, in particular, is a risky market. You don't know when new sanctions will be imposed on the country, but also you equally don't know when Russia will self-embargo its exports. It could hold back some of its exports from international markets, and has been threatening to do so repeatedly over the last 6 months. Now, it hasn't threatened platinum or palladium directly, but um, both of those metals come as byproducts of mining for nickel, and it has certainly threatened holding back nickel. If it holds back nickel exports, its funding for nickel mining may actually dry up, and therefore reduce its production of these metals, and therefore you could get some tightness presenting itself in some of these metals. So there is some upside risks for both platinum and palladium. um, One of the other risks is the fact that the markets just may have gone too bearish already, and you can certainly see that with palladium, where um, if you look at net speculative positioning in palladium futures, they had fallen and fallen drastically. Almost two standard deviations below its 5-year average back in beginning of October. We saw actually some of that come off, and so there was that nice um, short covering rally we saw, especially when Russia was making rumbles about doing some of those embargoes. So that drove palladium prices uh, quite sharply higher early in October. It's come off once again, but once again, if those shorts build up, that could happen again. Platinum isn't as short as palladium, but it is quite weak in terms of positioning. So any news catalyst, whether it's a supply disruption coming from either South Africa or Russia, or possibly any of the other major producers out there, that could drive that little bit of a short-term, opportunity for a covering rally. So, we think that, both platinum and palladium probably have less downside risk at the moment, and probably a bit more upside risk, given that most of the bearishness is already in their prices.
And do you cover some of the other precious metals, like the more esoteric ones, like rhodium? And as a corollary to that question, are those the kind of metals that smaller investors can be getting access to anyway? I mean, obviously, we're talking about some of the more niche metals out there.
Yeah, so the answer to that is yes. I look at them, but we as Wisdom Tree don't have products on rhodium and some of the other metals, mainly because they have significantly less liquidity um, than some of the precious metals we've discussed today, and as a result of that, it makes trading them very difficult. You have huge lumpiness in prices, huge spikes. It can be difficult to source enough of the metal if there is a sudden surge in demand, to put into the vaults, and that poses certain risks. So you know. They are less accessible, I think, for most investors. Um, Yes, there are a few products out there. One of the major product is a South African product, I think. But it's a bit more difficult for European investors to get hold of the asset, and hard to trade it in sufficient volumes is the more key issue. But rhodium is a one of the platinum group metals, and it comes, its supply is there as a byproduct of the mining for platinum, palladium, which is is the primary metals that are being mined for. So it has the similar sort of supply difficulties that platinum and palladium have, and therefore should there be a disruption to supply, rhodium could get a boost. Rhodium is generally used is for similar reasons, as in it is a uh, catalytic material. So used in cars and other applications to help turn nasty gases into safer gases, and is used coupled with platinum and palladium. Uh, very often with the palladium to uh, you know helping those catalytic roles. But if you see that decline in demand for palladium, then you're likely to see that long-term decline in rhodium as well. So there's, it has a lot of association with those system metals that it's are the primary metals that are being mined for.
And my last question, we've talked a little bit about market disruption, but one thing we haven't really touched on is the degree of influence that ETFs themselves have on these metal markets. Because obviously, over the last 15 years, we've seen more and more ETF products being launched into the market that actually invest in precious metals or precious metals futures. From your perspective as an ETF fund manager, I mean, how important are ETFs becoming in this space as a price mover in themselves?
Yeah. So, I talked a little bit about our gold forecast earlier, and one of the ways we um, forecast gold is through our proprietary model. And the model is an econometric model. And what I've done is taken time series of various drivers of gold that I could identify, took about 20, 30 variables, put them into this kind of multi variate framework. And, you know, through that process, I could discard things that haven't proven to be statistically important for driving gold prices historically. Now, through that process, I've identified what major drivers for gold are, and they include bond yields, dollar, inflation, and some measures of investor sentiment. There are some, they're the major things, and they account for about 65% of gold price movements. Then there's some things that look like secondary drivers of gold prices. Things like stock market performance, some other geopolitical sentiment factors that aren't captured in investor sentiment. But when you look at gold, the main drivers of gold seem to be these big macro um, factors, not so much the physical movement of gold, not demand, not either through jewelry markets, through central bank or ETF markets. So I've tested all these things individually, and historically they haven't proven to be statistically relevant, nor as supply. So if I look at mine supply or scrap supply, recycled supply, they haven't proven to be statistically important. Once a condition for those other things. Now, they may have a secondary or tertiary role in pricing that's not picked up with statistical significance, but that's where we are with the long-term historical data. But if you try to plot a line of ETF flows against gold prices, you'll see almost visually some sort of relationship historically, right? When gold prices were going up, ETF flows were also going up historically. So, um, Now, it may just be the cause is the other way around, right? That ETF flows come in once gold prices start to rise. So it may not be driving gold prices, it may be a result of gold prices. But then we saw a massive break in this relationship, right? Between May 2022 and May 2024, gold prices were rising, whereas ETF flows were negative, right? So outflows in ETF markets when prices rising. So it kind of does emphasize the point that that ETF flows probably don't drive prices because they went the opposite direction for a good period of 2 years. And in that 2 years period, not only were prices rising, but they were notching new highs very, very frequently. Um, so I don't think that ETFs are necessarily driving prices. I think the other things are the bigger drivers of prices. But now that ETF flows have resumed into gold, and we've seen some of the other drivers of gold, some of them remain positive, it may add a little bit to upward pricing pressure on the margin, but I don't think it's sufficient, and certainly not statistically relevant. Now, the other thing that I mentioned there was central bank flows. Historically, are not seen as statistically relevant, but the volumes we've been seeing in the last few years have been really off the charts. So that may be also adding a little bit of upward pressure for gold prices. But once again, with these kind of quantitative exercises, you need a lot of historical data showing that trend has been there for a while, and we just haven't seen enough years of central bank buying at these volumes. So it's once again hard to prove.
So like if you look back, I remember writing about gold like 10 years ago, and analysts used to focus on things like the Indian wedding season and the fact that buying in South Asia could drive the gold price. Would you say that kind of trend or that kind of seasonal trend is less of a factor now?
Um, Certainly there is a seasonal aspect, right? There is for demand. So you see, but you see that that's a seasonal aspect every year around the same time. And I know Diwali or Dhanteras or those things or wedding seasons, they're slightly different because the Indian calendar or Chinese calendar or are slightly different to the Western calendar. But broadly speaking, around certain quarters, you will see um, you know the volumes of demand increase. So from a volume standpoint, yes, it's very important. But from a price determination standpoint, I think it's slightly less important. And in fact, I would say these retail markets are often price takers. Um, and I would argue that when you see prices fall, that's when you see the volumes of buying in these markets actually increase. So the relationship is almost inverse, right? Not only the seasonal factors obviously push up demand, but that seasonal demand for gold or silver could be even higher when the prices are weak. So the relationship is slightly the wrong way around. Possibly adds a floor towards prices. If you see surges in buying, we saw that certainly in 2013, right, when the prices in the institutional markets in London and New York are falling heavily in 2013. You saw massive amounts of buying, especially retail buying in China, which helped probably draw a floor for gold prices at that time. But if you look at a correlation between the two, you'll see falling prices and surging demand. So it's the relationship, I think, is almost inverse rather than positive.
Well, thank you very much indeed for that insight, Nitesh. It's been really interesting speaking to you this morning about the precious metal market. I could go on all day about these, but I thought we'll conclude that there. So thank you very much for coming on the podcast and giving us some insights into what's going on.
You're most welcome. Thank you so much for having me back on.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.